When you think of Bitcoin, you probably think of its wild price swings, right? But the one thing it's never, ever done is pay out any kind of income. Well, today we're going to dive into a new fund that's trying to completely change that game, mixing the world of crypto with a strategy for monthly payouts. So, how on earth does it work? Let's get into it. Okay, so the fund we're breaking down is the NEO's Boosted Bitcoin High Income ETF, and you'll see it under the ticker symbol XBCI. Now, this is a pretty complex product, so we're going to unpack its strategy layer by layer, and we'll be using its official prospectus as our guide.
And this really gets us to the central puzzle, doesn't it? How can you possibly squeeze income out of an asset that doesn't produce any to begin with? Well, XBCI tries to solve this with a pretty clever, multi-layered approach that involves options, other funds, and even a little bit of leverage. Let's see exactly how they pull it off.
All right, first things first. We have to understand the foundation of this fund. What's its main goal, and how does it even get its hands on Bitcoin exposure in the first place?
So what's really interesting here is this dual objective. XBCI is trying to hit two targets at once, give you high monthly income and potential growth. But here's the crucial point you got to know. It doesn't just go out and buy Bitcoin directly. Nope. Instead, it invests in other exchange-traded products. You can think of those as funds that trade like a stock that do hold spot Bitcoin, and then it layers a whole option strategy right on top.
So, what in the world is a spot Bitcoin ETP? Well, think of it like a fund whose one and only job is to hold actual, real Bitcoin in its vaults. Its price is designed to perfectly track the price of Bitcoin itself. This is the absolute base layer of how XBCI gets its exposure to the crypto market. Okay, so the fund has its Bitcoin exposure through those ETPs. We got that. But where does the monthly income check come from? This is where things get really interesting. It all comes down to the fund's options strategy.
XBCI uses something called a synthetic covered call strategy. Let's walk through this step by step. First, it uses options to create exposure that acts just like owning Bitcoin. Then, it sells, or writes, call options against that exposure. For selling those options, the fund gets paid cash, which is called a premium, and that premium is the source of the monthly income. But there's always a trade-off, right? In exchange for that cash today, the fund gives up some of the potential upside if Bitcoin's price totally skyrockets. And this slide really draws a clear line in the sand. You see, in a traditional covered call, you actually own the thing, like, say, 100 shares of a stock, and then you sell options against it. But with XBCI, it doesn't own the Bitcoin directly. Its exposure is synthetic, meaning it's created through a fancy combination of other options contracts. That's a really crucial distinction to understand.
But wait, there's one more layer to this whole strategy, and honestly, it's a pretty aggressive one. This is where the boosted part of the fund's name comes into play. The fund is aiming for investment exposure that's equal to about 150% of its based Bitcoin strategy. So how does it do that? It uses leverage. Basically, it's borrowing to ramp up its exposure, trying to amplify both the Bitcoin-linked returns and the income it can generate from that option strategy.
So what does that actually look like in practice? This table gives a really simplified example.
If the underlying Bitcoin funds go up by, say, 10%, XBCI is shooting for a 15% gain. But, and this is so important, it works both ways. If those funds drop by 10%, the fund is staring down a 15% loss. That boost magnifies everything, the good and the bad.
And that brings us to what is, without a doubt, the most critical part of this entire explainer. With a strategy this complex, you absolutely have to understand the risks. Seriously, think of this next part as the big bold warning label on the investment.
Okay, risk number one is the asset itself. The fund's prospectus is crystal clear on this. Bitcoin's value is super volatile, it's largely based on speculation, and the market itself is open to big risks like fraud and manipulation. Plus, it's way less regulated than, say, stocks and bonds.
The second major risk? You guessed it, that 150% boost. Look, leverage is a classic double-edged sword. It juices up your losses just as much as your gains. A small dip in Bitcoin's price can lead to a really significant loss for the fund, making it way more volatile than a fund that doesn't use leverage. And hey, don't just take my word for it. This is a direct quote from the fund's own legal documents, and it's worth paying close attention to. They state very clearly that because of the leverage, the fund can lose more money than a similar fund that doesn't use it. Plain and simple.
And finally, we have to talk about one last crucial detail about those monthly payments. When you get a distribution from a fund like this, it's totally natural to think, hey, that's profit. But Not so fast. That's not always the case.
The prospectus itself warns investors about this. It says shareholders might think they're getting profits when, in fact, some or even all of that money could simply be what's called a return of capital.
So what is a return of capital? It's pretty much exactly what it sounds like. It's the fund giving you a piece of your own investment money back. It is not a gain or a profit. It just means a high payout doesn't automatically mean the fund is crushing it. It could just be handing your own cash back to you.
And all of this leaves us with the big question. XBCI offers a totally new approach, right? The chance for high monthly income and amped up exposure to one of the most talked about assets on the planet. But it gets there through a really complex strategy that's loaded with the twin risks of Bitcoin's crazy volatility and financial leverage. So, is the potential reward worth taking on all that risk? Well, that's a question every single investor has to answer for themselves.